Oscar Health experienced significant headwinds to its cost structure in 2025, but the management team is hopeful that in 2026, the higher prices it will charge consumers, which the company is estimating a 28% increase on average in its premiums it will charge, will help offset the higher cost, and profitability will return to positive levels next year. So does that make Oscar Health stock a buy for 2026? I'll answer that question in this video. So since 2019, Oscar Health has done a great job at expanding the business, gaining new customers, and increasing revenue, which soared to $11.1 billion in 2025. That's up from around $500 million in 2019. The trouble with Oscar Health has been on the cost side, and that's been the case for United Health and other health insurers, as the cost to serve customers in 2025 turned out to be much higher than nearly every healthcare provider estimated. So going into 2026, to offset the higher cost to serve customers, companies like Oscar Health are increasing prices. In fact, the management team said that on average, it will increase prices by 28% compared to 2025. That's a big increase. And United Health said similar statements that it will be raising prices for 2026 as well. And I'm sure you've been hearing about this on the news, with health insurance prices, healthcare prices going up for consumers starting in this next year's enrollment period. So I mentioned profitability had been the headwind for Oscar Health, and it's been that way for several years. This company has only generated 1 year of positive returns on invested capital, and that was barely 1.7%. But if we look back from 2019 to 2025, we can draw a nice upward trend line in improving return on invested capital from negative 30% to negative 5.7%. The management team also initiated tens of millions of cost cuts in 2025, administrative cost cuts, and coupled with the increase in prices, management is very optimistic that profitability will improve in 2026. The cash flow from operations has been volatile, but has been positive more often than the returns on invested capital. Sometimes companies will have non-cash expenses like stock-based compensation that are an expense on the income statement, but they're not a negative to your cash flow. Click the link below to watch the full video.